Hi, welcome back to your 5-minute Seattle Real Estate Monthly Update. It's TC Wu here, and in this channel, we cover everything you need to know as a property owner or investor. Please subscribe and follow us so you can receive our weekly 1-minute updates as well. If you're considering selling, buying, refinancing, or renting because of you think the interest rate will go up as the federal funds rates go up, please stop and watch this. I'm just gonna say it because this is really important. Increase in federal funds rate does not equal to increase in mortgage rates. In fact, on July 26, when the Fed raised the federal funds rate by 75 basis points, what happened to the mortgage rates? It actually went down from 5.5% to roughly about 5%. Federal funds rate is actually the interest rate banks charge each other for overnight borrowing. When the Fed changes the federal funds rate, it creates a huge ripple effect throughout our economy, but it doesn't cause home mortgage rates to go up or down. Please take a look at this. What I have compiled here is the historical 30-year fixed mortgage rates, which is illustrated by the red line here, and the federal funds rate, which is purple. If you look at only what has been happening this year, it's easy to come to the conclusion that the two rates are highly correlated because both of them shot up drastically over the past few months. However, if you dig a little bit deeper and look at the past 20 years, you can see that the correlation is actually very weak, and one definitely does not cause the other one to go up or down. In fact, there's so many times where the rates actually go the opposite directions. By the way, the link for this graph is provided for you in the description below. Now, if you're looking for something that's indicative to the fluctuation of mortgage rates, look no farther than the yield on a 10-year Treasury note. Take a look at this. As you can see, the 10-year Treasury note yield, which is shown as the green line here, is almost moving in sync with the 30-year fixed mortgage rates. Think of it this way. Investors are constantly looking for the best rate of return on their investments adjusted for the relative risk exposure. As a result, they compare the different fixed income products such as money market funds, mortgage-backed securities, and of course, Treasury notes. Specifically, Treasury notes, which are backed by the US government, are considered one of the safest and most secure investment options out there. By comparison, mortgage-backed securities are riskier and therefore need to be offering higher returns to investors. So, when Treasury yields rise, investors demand higher returns on mortgage-backed securities to justify for the higher risk, and which is why you will see the two rates shift almost in the same directions closely. The takeaway here is that do not base your selling, buying, refinancing, or renting decisions on the notion that the upcoming rate hikes by the federal government will cause higher mortgage rates. Do not give in on the fear of missing out. And please be sure to find a qualified real estate or mortgage professional that will look out for your best interest and give you the right advice given your particular situation. Well, with this out of the way, let's talk about where the real estate prices are headed in light of the looming recession. Redfin just published a map that they call Real Estate Downturn Risk Map. Some people call it a crash map because it shows the risk for each metro area to have a housing price collapse. Generally speaking, the most at-risk cities are the destination cities that experience huge housing appreciation from migration during the pandemic. To find out if your city is vulnerable to a housing crash, you can find the link in the description below. Just to put things in perspective, please note the risk score ranges from 0 to 100, and the lowest score currently is at 29.6, which is at Akron, Ohio. And the most at-risk city is Riverside, California, which receives a score of 84. For the greater Seattle area, we have two cities on that list, and that is Tacoma and Seattle. For Tacoma, we're considered to be at higher risk with a score of 55.5, and for Seattle, on the other hand, is at a moderate risk of 47.6. However, one thing that really jumps out at me is the fourth column right here, which is a national ranking of how quickly housing market has cooled in the first half of 2022. Take a look at this. San Jose, Sacramento, Oakland, California are ranked 1st, 2nd, and 3rd, while Seattle and Tacoma are ranked 4th and 9th place on that list. One thing the cities have in common is the booming tech industry in the nearby area. As the tech industry is hit relatively hard during the downturn, what we're seeing is these growth-oriented companies tightening their belts and be more mindful about their business plans, expenses, and hiring. And for many buyers from the tech industry, their down payments might be coming from their stock portfolio, which had also taken a hit from its peak. So with that said, what is the data saying for the greater Seattle real estate market? Let's take a look. The median price single-family home in King County is now $900,000. And compared to a year ago, this is roughly an increase of 3.4%. However, compared to last month, the median home price was at $925,000, so we actually had a price drop of 2.7% just over a 1 month period alone. For the properties that were sold, they were on the market for 7 days on average before accepting an offer. This number went up slightly by 1 day compared to last month. For the properties that were sold last month, they were getting right around their asking price. As mentioned in my previous video, the extra profit sellers were expecting from bidding wars is officially gone. In total, we have about 3,800 homes available for sale in July in King County. Compared to last month, we have about 10% more homes available for sale, which is good news for home buyers. One thing I want to do here differently is to show you the 3-year graph. As you can see, our active listings are beginning to reach the level we had prior to the pandemic in 2019. When we compare how many homes are currently for sale to how many homes that were closing, we have roughly about 1.7 months of supply. As a balanced market is between 4 to 6 months, we're technically still in a seller's market. However, as I mentioned in my last video, the data is definitely showing that the table is turning as buyers are facing less competition and sellers are getting less for their properties. As always, thank you so much for watching. Hope you find the information helpful, and please contact me with any real estate questions. Please subscribe to this channel so you can receive our weekly 1-minute updates. I wish you well, I wish your family well, and look forward to seeing you next time.